for the private credit market, there will be a premium to that, but it can't be a disconnected premium, right? As a borrower, people structure private credit deals because they are bilateral private instruments. And you want to have a sense of control as to who your lender is. If the markets dislocate, you could see situations where people end up with more exposure than they would ideally like to have.
Welcome to Termgrid Talks. We are joined here today with Akshat from KKR Capital Markets in Europe.
Thank you for having me.
KKR Capital Markets has a very unique perspective on the financing markets, just because you are also a preeminent borrower. You're also a lending business. You also have the underwriting capabilities similar to that of a bank. So from that, all those vantage points, would be very curious to hear your perspective on where the financing markets are today for each one of those personas.
Yep, no, absolutely. From that vantage point, I think we've seen, through this year, particularly from the transactions that we've been involved in, it's been a very active and borrower-friendly market. You see all the various pools of capital back at, forming incremental capital. So private credit fundraising has kind of, improved again. And so you see people, keen to deploy funds on the private credit side. CLO formation has been very strong this year. So you see that backlog in kind of CLO formation coming through, and that's created a pretty good environment for issuers. Sitting from a vantage point of a borrower, it's a great time to be out there to raise capital for whatever you're looking to do, whether that be new LBOs or acquisitions for existing portfolio companies or dividend recaps. We see the market kind of increasingly open to more creative, solutions and ideas. Okay. And what we've also seen is deals where private credit and the syndicated market work hand in hand. So syndicated deal in your euro CLOs with other currency components going to the private credit market. So whether that's a sterling tranche or one of the Nordic currencies, etc. And we've seen a number of those types of deals where you're kind of marrying very different pools of capital, but into the same structure and the same document.
And do you see the hybrid structures being back in the market where we are today?
Yeah, I think so. I think historically the hybrid structures have existed in that the senior structure was primarily syndicated and the junior structure was privately placed. So it's not a new phenomenon, but within the same ranking of just a senior cap structure, that kind of phenomenon I think will continue to prevail. Primarily because large businesses, large global companies require funding in multiple different currencies. The depth of the market is still not back to what it was, I would say pre-COVID, which means that if you're looking to do a very large LBO, you want to tap different pools of capital, different currencies and pockets, whether that's bonds and loans or private capital with public capital.
And is that the lens with which you think about like a new placement, let's say as a borrower, when you're evaluating the competitiveness of all these different structures, be it bond, be it private credit, be it the syndicated markets, is the complexity of the business obviously is one factor of that. But for a structure where all three can work independent of each other, how do you think about competition from that perspective?
Yeah, so I think look, what we try and focus on is trying to find the right capital structure that fits the equity investment thesis. So it might not, although you certainly care about cost of capital, it might not always just be about finding the absolute cheapest cost of capital. It depends on what you're trying to do with the business. So, let's take, for example, a buy and build strategy for one of our portfolio companies. In that scenario, you want ease of access to incremental capital to be able to kind of continue to deploy and raise funding for incremental M&A. So that can be either in the form of a delayed draw term loan, which is more common in the private credit world, although you are seeing some delayed draws being broadly syndicated. And so if you're looking at a company that is very M&A focused, that's looking to run leverage at a higher level than what may be kind of broadly accepted in the syndicated markets, private credit might be the right solution. Or if you had a multitude of currencies that you wanted to solve for, private credit might be the right solution. If you're looking at a business that's mature, well understood in the syndicated markets, has been a previous issuer, or something that's very large, you might want to do the syndicated markets just to provide that kind of depth of capital. Although private credit has got increasingly large, and we're seeing multiple billions being financed in the private credit market.
So between the structures that you evaluate on each and every transaction, be it a bank structure, a bond structure, a syndicated, or unitranche for that matter, are there like certain economic terms, certain like doc terms that are particularly applicable to each one of them as you think about the pros and cons of each?
Yeah, so I would say on a broad basis, all three markets, kind of the private credit, unitranche, the high yield bond, and the broadly syndicated loans, work somewhat in unison in terms of kind of overall returns. Now, each market might not move as quickly to adjust, but over time they tend to gravitate, in the same direction, right? So this year we've seen tightening of spreads across all three markets, and that's because market forces, mean that if you want to be competitive as a private lender, you need to go tighter to compete with the syndicated markets. So in general, I would say economics-wise, you have, CLO in the loan market. Primarily, the cost of CLO liabilities is what will drive over a longer period of time where new issuance settles, because the CLO arbitrage needs to work. And so, if CLO pricing on a blended basis is 140 basis points, that means that, the broadly syndicated loan market on average across the portfolio will have to be somewhere in the kind of high 300s, low 400s from a margin perspective. I think what that means is for the private credit market, there will be a premium to that, but it can't be a disconnected premium, right? So going back to kind of the 600 over margins that we saw during the market dislocation is going to be unlikely in the near term for strong credits. And so that means that the kind of high 400s, low 500s margin is a fair place at the moment for the private credit market. In terms of docs, I think most markets have converged. So the high yield covenants came to the loan market quite a while ago now, and I think has become generally accepted for the large cap transactions. And I think that's now primarily also accepted in the private credit market. So I think you're seeing documentation across broadly syndicated term loan B and private credit converge more and more over time as the two markets compete for similar quality and size of businesses. I think if you're still looking at the mid-market, I think there's a difference. So, it's not that the terms are equal for all sponsors and for all issuers. But in general, for the really high quality, large cap transactions, I think documentation is becoming less and less of a concern.
Switching gears a little bit, in terms of the outlook of the deal flow, this year we've seen record year for the KKR Capital Markets business as it was announced. So what is your kind of in-house view of what the outlook looks like for the next 6 to 12 months?
Yeah. So look, as you mentioned, we've had a strong year in terms of issuance, both for KKR portfolio companies as well as third-party clients, and we've kind of continued to grow that business and win new clients and new sponsors that transact with us on our platform, which we're extremely grateful for. I would say there's been a good mix of new M&A driving issuance. So we've done 5 new LBOs this year on the private equity side. We've done a number of transactions on the infrastructure side, including the largest one that we've done to date with Telecom Italia, which the team has worked through, and a number of our kind of sub strategies, including our growth strategies and things of that nature. So capital deployment kind of continues to be on pace for us. So we haven't kind of seen the slowdown in deal volume for KKR sponsored transactions.
Okay.
We've also seen a very, very busy year in terms of portfolio activity. So whether that is extending maturities in the capital structure, repricing transactions, bringing transactions that were done in 22 and 23 in the private markets to the broadly syndicated markets to reduce that cost of capital in line with what we've been discussing. And so, across all the kind of, various themes, we've been quite busy, as a house. And we have seen some M&A volume kind of, start to pick up over the course of the year.
Okay.
And also a lot of opportunistic transactions where people are taking, dividends or raising incremental capital for M&A. And so from our standpoint, I think it's been a good year. I would say it feels like from talking to market participants across the street, most people have had a good year and kind of tended to meet budget. But what we haven't seen is that wave of M&A and large LBOs coming back where sponsors are trading existing portfolio companies with other sponsors. And it feels like we've been saying that for a while, that's due to start again. But if you just take a step back and look at the factors that will drive that, with private equity having record amounts of capital to deploy, private equity requiring a return of capital to their LPs for older vintages of funds, and financing capital readily available and reasonably priced, we feel quite good that 2025 should be a year of meaningful activity on the new LBO side, which is what has been missing in 2024.
This year, I think a lot of activity was repricing activity, just because of the syndicated market really driving the repricing wave. Do you expect that to continue, or in the portfolio itself, like majority of the repricings are kind of like behind us now?
Yeah.
And now it's really the M&A that has to drive the deal volume.
Look, I would say a lot will depend on kind of where CLO liabilities go. If they continue to tighten, you could potentially see another leg down. Although if you just look at spreads in general, we're probably at the 90th percentile of tight spreads. So there's not that much to go from here, right? So you could have another 25 bips or another 50 basis points at an extreme, but it's hard to see us kind of getting to an environment where we're talking about kind of 200s and 300s from a spread perspective, just from a historical context.
Okay.
What's helping is base rates are coming down. And so anything with a fixed coupon then will benefit from a kind of a new issuance or a refinancing, and overall cost of capital coming down, which means that people can afford to borrow more for the same amount of earnings that the company has. So I think, to your point, add-ons for M&A, add-ons for dividends, new volume for new LBOs, I think that will be the primary driver for next year.
There has been a lot of innovation that is coming to the private credit market because of it being the golden age of private credit. One such innovation is the trading aspect in the privately held loans, really grabbing headlines, and some of the firms announcing initiatives and capital behind creating a secondary platform. What are your views on that? Where do you think this trend is going to go?
Yeah, look, it's a super interesting topic because I think there's two competing sides to this. One, I think you're getting more and more capital on the private credit side that's raised from individuals and high net worth individuals. And that product promises liquidity to their underlying clients, which means that the liquidity of the asset class does need to improve over time for that to match. And I think that is what's driving a lot of kind of private credit lenders to take a more active approach to portfolio management. So whether that is diversifying your portfolio by doing smaller tickets in lots of different deals, or incrementally adding to your exposure over time in a transaction as you raise more capital, or if you have outflows of capital, trimming your exposure. So I think that's a phenomenon that will probably continue to gain prominence as that portion of the market becomes a larger and larger source of fundraising for the private credit market. But on the flip side, as a borrower, people structure private credit deals because they are bilateral private instruments. And you want to have a sense of control as to who your lender is and who you're speaking with, when you have a request, when you require incremental capital, etc. And so I think a big topic is, how easy is it to trade a private credit loan? I think you will have people that will step up to make markets in these instruments over time. The friction costs will initially be quite high because they're not that liquid. So the bid-ask spreads and what's happening in the middle will probably be reasonably dilutive from a trading on a regular basis. But on the other side, you'll have very restrictive transfer provisions in the credit agreements, where whitelists are much smaller than in the broadly syndicated loan market, and there are a lot more controls as to how easily you can trade this instrument. And so I think there will need to be more of a conversation between private credit providers and borrowers to kind of come to an understanding of what that instrument really is, and part of that will feed into some of the terms that you have, right? So if you have a mid-market covenanted unitranche document, you don't want that to be freely tradable from a borrower perspective and in the hands of the wrong people.
Right.
But if you have a very large, quasi term loan B syndicate with 10 plus private credit lenders, which is cov light and very flexible, you might be a little bit more comfortable with people trading in and out of those positions.
So it's still a small market, but
I think a growing market, and over time, I think you'll continue to see innovation around that.
one of the other phenomenons that is increasing in the market, and would be good to get your perspective on, is that the private credit universe, given the amount of the size of the funds that the institutions have been able to raise, are writing bigger and bigger tickets. And because of them writing bigger and bigger tickets, they're also starting to syndicate it on the back end to sell down their positions to other either private credit lenders or other institutions or LPs. What are your thoughts on that sort of a trend? Do you see more of that happening? What are some concerns that you might have? The same way on the liquidity question that we discussed, or the secondary liquidity.
Yep. No, so look, it's definitely a phenomenon that has kind of gained prominence. So I think you see a lot of private credit lenders, I would say for the most part, looking to syndicate to LPs on the back end. I think that's also a phenomenon driven by the fact that LPs are asking their GP relationships to provide them co-invest in transactions as a way of kind of increasing their exposure to the asset class. I think it's interesting to see how that kind of progresses, because in a fully functioning market, I think that's probably a good trade for people where everybody kind of gets what they want. But if the markets dislocate, you could see situations where people end up with more exposure than they would ideally like to have in a transaction if they haven't been successful in syndicating to LPs. And given some of the restrictions around transferring the product to other GPs or just selling it down in the broader market, that could lead to some more slightly tricky situations. But what I've seen and what we've been involved in as a firm quite a bit is kind of underwriting to a private credit syndication. And that's not something that I believe is going to be the future of the market under all circumstances, right? So the private credit market is a private market, it's a direct market, but there are some instances where people need speed and certainty on transactions, whether that's a public to private or a bilaterally negotiated transaction where people don't want to approach 10, 15 lenders to negotiate a club transaction, where you might approach somebody and say, I want a 100% solution. And that's a capability that we've worked very hard to develop over the last 2-3 years, and provide people with that certainty, where we might hold some of the transaction in our private credit pools, we might underwrite a portion of the transaction through our capital markets business, and then distribute that to other participants and also to LPs in the market. And I think that's a value proposition that's quite attractive for people, but in certain circumstances. It's not something that I view as becoming the norm for all private credit deals.
So Akshat, let's rewind the clock back, because we are in now COVID times, which is the first time when we met each other. This is mid 2020, the peak of COVID, and there's a technology solution that the team is evaluating, which is Termgrid in this case. Take us back into that view as to what made you take that plunge.
For us, it was about trying to find ways to work with technology to frankly make our lives easier. As capital markets professionals, at the time we had a lot going on, and a small team at the time, which has grown substantially since, but so has our portfolio. And it was about trying to create efficiencies on how we interact with lenders and our relationships across the market, and capture data, and figure out how to make the best use of that information, in a sensible way, without making it extremely manual on people in the team. And it's been great to be part of this journey to try and figure out what incremental features we have got added over time, and how the product has kind of grown and flourished. And congratulations on all your success and all the new customers you have. But hopefully we'll always have a special place in Termgrid history.
Absolutely, you're always be very fortunate to be working with you, and yeah, it's been an amazing journey, and hopefully it continues for a long time.
Thank you.